Today, we're joined by Henry Chin from CBRE to break down their mid-year economic outlook report. And if you're wondering where the economy, labor market, and real estate sectors are headed, this show is for you. I'm Kathy Fetke, and welcome to The Real Wealth Show.
You're listening to The Real Wealth Show with Kathy Fetke, the real estate investor's resource.
Henry and his team just released CBRE's mid-year economic outlook, offering fresh insights into the economy, capital markets, and key real estate sectors. We'll dive into what changed since the start of 2025, how tariffs, interest rates, and labor market shifts are reshaping the forecast, and where the biggest opportunities and risks are for investors in the months ahead. Hi, Henry. Welcome to The Real Wealth Show.
Hello, Kathy. It's great to be here with you today.
Thank you. Let's start with what is CBRE and what's your role there?
Okay, before we talk about CBRE, I want to introduce myself a little bit more. Originally, I am actually from Taiwan. I was educated in the UK. I started my career in London and moved to Hong Kong. I just actually relocated to the US, Dallas, last September. Now I'm looking after the research function globally for CBRE. So CBRE is a global real estate advisory company. For my department, as a research, we do have 500 researchers to analyzing the global commercial real estate market, the different dynamics, demand and supply, to provide an insight to our clients and to make the decisions.
I always thought it was a brokerage. So it's just a research firm?
No, it's a brokerage company, and
Yes.
my department is a research department.
Okay. Thanks for the clarification. CBRE just released its mid-year economic outlook. How does it compare with the projections you shared at the start of 2025?
Yeah, from the macro point of view, I think we have lowered our whole year GDP forecast as well as the job growth numbers, but we also increased our inflation projection forecast. However, in the commercial real estate side, we maintain our forecast in terms of leasing and the investment activities. So overall, economy, we lower the projections. On the real estate side, we maintain our forecast in the mid-year.
And what is driving that adjustment?
Like many other economists, we adjust our GDP forecast to reflect the uncertainties which we are seeing by policies such as tariff and the fiscal deficit. And that is the major drivers for us to look at our forecast to make sure our adjustment is reflecting to the market condition.
You know, I only pay attention to economists here in the U.S., not in other countries, but you've been in other countries. Are they having the same reaction to the tariffs, just and the uncertainty there?
Yeah, 100% aligned. And I think the economists in Europe, economists in Asia Pacific, all feel the same thing because the tariff does create disruptions around the global supply chain and how global economy used to operate. So therefore, we are so busy to look at the different policies to make sure our forecast is reflecting to the market condition.
Yeah. In your experience, have you ever seen this kind of shakeup before?
No, we haven't seen such massive changes for the tariff for a long time. So therefore, when we look at a historical event, Kathy, just to let you know, I think the geopolitical effect have never been a major driver for economy cycle. But because the tariff is triggered by the policies, and that it causes some supply chain issues, it causes some how global economy operates. So therefore, everyone is getting very anxious about what is going to happen going forward.
So the projections are that because of the uncertainty, there will be less trade in general, people buying less, people importing less, or just waiting to see what happens?
I think over the past few weeks, we do see some welcome trade agreements which is concluded with U.S. with other major economy partners. I think that is a welcome news for the global economy and for the commercial real estate market. And then it's also a welcome message for the business communities because all the business communities, what they want is to have the very clear clarities around policies.
Yes, and investors hate uncertainty, right? So
Yeah.
what we did see in the latest inflation report was a tick up in inflation. What are your thoughts on that? Does it seem to be a trend or a unique moment?
I think we highlighted, I think we have increased our inflation projection for 2025 and even into 2026. I think the inflation is going to be lingering around 3%. And then before we start to decline, to see the decline into 2027, I think that is the reality we all need to be, face.
Yeah, because there were a lot of people, a lot of conjecture, people saying that, well, we haven't really seen inflation yet, and that was towards the beginning of the year, but we hadn't really seen the tariffs take effect either, and that was supposed to happen right about now.
Yes.
So we don't really know where inflation's going to land, but like you said, most are expecting it to increase. So
That's correct. That's correct. And Kathy, I also want to highlight one interesting point. There are so many noises around the data in the US economy over the past few months. There's a divergent trend between the soft sentiment data together with the hard data coming from the economy, coming from the financial market. And so therefore make our job even more harder because sentiment tends to be soft. But the fundamentals seems to hold on relatively well. And what does it mean for economy and what does it mean for real estate? So that's why we keep monitoring the situations on a weekly basis to make the judgment call as well.
And a tough judgment call for the Fed as well in September. If they're seeing a tick up in inflation, but job growth is slowing, I think it's 90% of economists believe that they will cut rates in September. But who knows with this latest inflation report, right?
Yeah, you're right. Actually, I have to say, Fed does have a very, very tough job to do. Number one, you think about economy growth is below the trend. So in normal situation, this weaker growth will warrant the rate cut. But if you look at the inflation number, employment data still shows some mixed messages. As of now, we do expect to see the Fed to cut the interest rate in September and probably twice in 2025.
Okay.
2 to 3 times into 2026.
Okay. Yeah. So that's good for commercial real estate, right?
It's 100% correct. It's good for real estate because we do want to see the rate to come down in order to investment activity to pick up as well.
Yeah, it's such a fine line, right? You see things that people don't really like, which is higher inflation. No one wants to pay more for things, and that a slowing job market. So these are not great. But if that leads to rate cuts, it's good for real estate. So it can be confusing, right? Like, how does that work? Real estate is so dependent on people and how they spend their money. Do you think that tariffs and the potential for inflation will continue to slow down construction activity?
Yes, that's what we are seeing because if you look at a replacement cost, which is material construction cost and labor cost, is increasing quite substantially. It's going to hindering around the new construction activities. So which again is good for real estate. We don't have a wave of a supply to the market. So therefore demand is slowing to picking up. So therefore the balance of demand and supply will reach the new equilibrium. That's why we start to see some rental growth.
Yeah, so there was a bit too much supply over the last year or so.
Yes.
And that if there's not enough construction happening, but also when construction starts to decline, that's a lot of job losses as well, right? And that's going to affect the economy. So do you have concerns? You just talked about rental rates. If there's a slowdown in job growth, is that going to affect rental rates if people just can't afford to rent?
Well, people looking at the labor market, we know the job growth market, labor market is indeed cooling. But when I was looking at the global economy, even look at the US unemployment rates in a historical context, I think the unemployment rate data in the US is still at the lower level, right?
Yes.
So we do see the cooling labor market, but while we looking at the real estate market in the US, we do believe has bottomed out. And that the investment volume is coming from a low base. We're going to see the 10% growth this year. And leasing activity is very resilient for the right products. So overall, I think people overly negative and sensitive about the cooling labor market, but overall the unemployment rate still at the lower side.
That is so fascinating to be speaking with someone who's got a global view on things because, yeah, like I said, we focus on the U.S. I don't know what's going on outside the U.S. very much. But in comparison, you're saying that our employment rate is better than other countries for the most part?
Yes, in a low 4% unemployment rate is very, very decent for the U.S. economy.
Okay, well, that is good news, and that translates into demand for real estate, like you said. All right, well, let's talk financing and rates and commercial real estate. Do you see commercial lending rates coming down in the near future?
I think our 10-year treasuries forecast still remain around 4 to 4.5%. So the loan rate still relatively on the higher level. That is a speed bump for the real estate investment volume to recovery. I think we believe it's going to recovery. Just the higher 10-year treasury, it creates a speed bump for us. When we are looking at our data, we do look at the leasing sentiment activities has already picked up quite substantially and over the last few quarters. I think traditionally, banks has been, relatively conservative over, during the rate high cycle. But now we are seeing the bank lendings has already picking up for commercial real estate markets. We see the margin has been declined. We also see the LTV ratio has increased. The most fascinating fact is we also see some alternative lenders are coming to the market. Around 34% of lendings are conducted by those alternative lenders, and which is led by the private equity funds. So overall, the availability of a finance is available, and then we do see the lending environment is improving.
We just did a show on this, that there's more private money coming in and offering more options for people. But the 10-year treasury yield you expect to remain high in
Yeah,
spite of slowing job growth?
yeah, that's what we currently believe. I think based on all the data we are having now, we are thinking about the 10-year treasury is lingering around 4 to 4.3% for the foreseeable future. Put it that way.
Okay. And is commercial real estate more tied to what the 10-year treasury yield does or what the Fed does when they cut rates?
I think the cap rate is highly correlated with the 10-year treasuries because when we are looking at real estate investments, we also need to have a risk premium. When we talk about risk premiums, use the cap rate to compare with the 10-year treasury, which is risk-free rate. So that's why, although the real estate market has repriced, cap rate has moved out, which is a great news. But 10-year treasury is still lingering around 4%. And that's why we can't see any significant cap rate compressions over the next 6 to 12 months. What I say is the cap rate has repriced during the last cycle, right? During the current cycle, cap rate has increased quite substantially. We do believe a cap rate have peaked. In normal circumstances, when the occupier leasing demand is coming back, we are going to see the cap rate to compress together with the 10-year treasury. And because the 10-year treasury is still lingering around 4.5, 4.3%, so the cap rate compression is going to be a lot slower, a lot milder compared to the previous cycle.
For people who don't understand what that means, if cap rates have peaked, what does that mean for buyers today?
The buyers, what it means for buyer is basically going forward, what you are expecting to see is the capital value to increase. Because when cap rates peak, that means the value has dropped to the bottom. So therefore, the value going forward should increase further. So that's why, as our current forecast, we think about cap rate have peaked. Going forward, it's going to compress mildly. So therefore, your value is going to increase. That's a good time to invest in real estate in 2025.
That sounds like a great time. No, this is really great news because it's always so interesting. I've been through a few real estate cycles now, and people were buying apartments and commercial real estate at 2 caps. And, where do you go from there? I think even someone paid 1 cap for an apartment in Houston. And a lot of us were kind of scratching our heads like, where do you go from there? I mean, what are your thoughts and what would you tell people buying a 1 cap?
It's fascinating. Before I come into the US, Kathy, I was in Hong Kong running the research across Asia Pacific. I always use the terminology with some of my clients in Australia. I call it in La La Land because
Yeah.
at that time they're talking about commercial real estate market are trading at a 4% cap. When I put my money into the 12 months deposit, it generates 5% interest rate. So therefore, there's no point to buy real estate. So therefore, the real estate needs to be repriced. That has happened now in the other part of the world as well. But the great thing is the US, we are leading the repricing. So the price, the real estate price has repriced. The cap rate has peaked. So going forward, in the right product, right segment, we're expecting to see the cap rate compressions.
So please, all of you listening, this is probably one of the most important things to understand if you're going to be investing in syndications or buying property is you don't want to buy at the peak. And too many people were in 2022 not really understanding the cap rate analysis here. If you're buying at a 1 cap, how do you fix it up and improve it? You're going to sell it at a 0 where there's no return? I mean, where's the room for improvement there? Whereas today, what would you say the average cap rate is, let's say in Texas on a multifamily?
I think the cap rate overall is way above 5% now.
Yeah. And like you said, people were investing in projects or buying properties at let's say a 3 or 4 cap when they could just go put their money in the bank just a couple of years ago and get 5 or 6%. It just does, the math doesn't work. It just doesn't make sense. And like you said, it has repriced. Things are back to balance. And now you have this opportunity to get in where there is room for price growth. So that's exciting. That's why we're starting our fund.
Kathy, that's correct. When we are looking at the real estate pricing, the easiest matrix for us to look at is real estate cap rate versus 10-year treasuries. If real estate cap rate is above your 10-year treasury, that normally what we mean is it's relatively attractive because that's the real estate is cheaper than risk-free rate.
It's cheaper, and then you can go prove it and then sell it for more. Yes, it's the basics of real estate. Thank you so much for explaining that. All right, and on top of that, on top of the fact that cap rates are higher, you can probably buy more deals. They maybe haven't been renovated over the years because people were just trying to get by. On top of that, there's tax benefits. We know that the new tax bill, the OBB, brings some tax benefits. Do you think that will fuel buyers into real estate, into commercial real estate?
Actually, first of all, I want to declare I am not a tax advisor, and the tax system in the U.S. is very complicated. But in general, what we are saying is that the tax spending bill is actually favorable for commercial real estate, especially for the two fronts in my mind. Number one, the corporate tax is a lot lower, so which is good for real estate. Second one is they do allow some expenses of the property improvement as a part of the tax deductibles. So therefore, it could benefit for investors to look at for distressed assets, distressed areas. Potentially, you spend money to improve your properties. That can be attractive for some opportunistic investors. And so therefore, that's a big plus. So overall, we think it's a welcome news for real estate investment.
And are certain asset classes doing better than others at this time? Like have some not quite bottomed out yet? They still have further to go?
I have to say, I'm very happy to say commercial real estate markets across all the 4 segments has bottoming out. And we do we do see the stronger leasing activity has recovered in office. Retail a little bit plateau, and industrial is on the upside, and multifamily bottoming out. So therefore, I have to say we probably has passed the trough already.
And are there certain markets that are recovering faster than others at this time?
Yeah, 100%. The gateway market is outperforming in every single dimensions. For example, in 2022, Kathy, I was in New York. I was walking around in New York after COVID. And I realized, wow, the retail recovers, but no one was in the office.
Nobody's there, yeah.
But now the things has changed. The retail continue to outperform well, and the people are returned to the offices. The demand for Midtown Manhattan is so strong, particularly in the prime segment. We start seeing some spillover demand from the grade A spaces and moving to A minus as well. So therefore, I think the recovery in this gateway markets is excellent.
San Francisco, LA.
100%. San Francisco.
New York, yeah. Miami as well.
Miami is having a bit of a challenge, and because I think Miami, they do have a wave of supply. So therefore, the
Mhm.
rent could be a challenging. So therefore, I would classify Miami as more of a landlord, a tenant favorite market rather than landlord favorite market.
And then what about the All-Star Texas? I've heard, it's slowing down. I've heard it's still growing like crazy. What are you seeing there?
Some pockets of Texas, Dallas is doing particularly well.
Hmm.
Because I live in Dallas, I can tell you that some office clusters in Preston Center, the vacancy rate is below 4%. The
Wow.
rent is shooting up. So therefore, we see some demand coming to the other part of Dallas as well.
And you recently revised your 5-year rent growth forecast from 3.1 to 2.8%. Which markets saw the steepest downward adjustments in rents, and which ones are ready to bounce back?
So you mentioned about for the multifamily sector, right? So
Hmm.
so the multifamily sector as a nation, we do see the market has bottomed out in the second quarter of this year, but we do expecting to see the widespread of recovery into 2027. That's what we are seeing. And in terms of the market, which is laggers and leaders, the laggers is going to be a high supply market, such as the Sunbelt market and mountain regions. And then when you are talking about the leaders, will be the Midwest market and the Pacific Northwest market. The rental growth is strong, is leading the growth.
Wow. Just kind of a flip-flop from a few years ago. And finally, this one is shocking. You say that CBRE is forecasting a 19% gain in office investment volume this year. I guess it's not that shocking when values, drop so significantly.
Yes, I have to say I have been very, very bullish for office investment globally since 2024. And
Hmm.
I do believe office investment thesis, but we really need to be selective, Kathy. And because you said the value has dropped quite substantially. But when I was looking at the demand side, the demand side has been so strong, particularly driven by finance, legal, insurance. Now we got the AI sectors in those gateway
Yes.
cities. And but one thing to be mindful is the occupier are particularly focusing on the good quality of assets and specific locations. We just did a survey study, which is launched this week, talk about office occupier sentiment. There's two highlights I really want the listener to pay attention to. Number one is 2/3 of companies we survey. They are telling us we are going to maintain or to expand our spaces for the next 3 years.
Oh, wow.
That's one thing to be mindful. Second one is that 50% of the companies, they tell us, I do have a concern of the availability of desire spaces because I want to rent this particular area or building. There's no availability at all. So therefore, they do have a concern. So, and the right product and right location is going to be outperformed. In terms of the right product, they are telling us they particularly focus on the transportation. It's easy to go there, enough car park. And number two, surprise, surprise, it's all about F&Bs. Do we have enough F&B options and for my staff to use? So those two stands out quite substantially during this year's survey.
What's an FMB option?
Food and beverage.
Oh, food and beverage. Yeah, and food and beverage got hit hard when the offices were empty. Then all the stores and all the businesses around it kind of died. So I guess that'll be coming back as well.
Yeah, I just give you the anecdote. Today, lunchtime, I went downstairs to get my sandwiches and I have a wild guess. How long do I need to wait for my sandwiches? Half an hour.
You're just going to have to make your own. All
Thank
right. So same for industrial storage. That was hot, hot, hot for a while. Will that continue?
I have to say, when again, because I was coming from the other side of the world, I think the industrial market, the changes has happened, was leading in the other part of the world, particularly in Asia Pacific. And over the last 18 months, the Asia Pacific market has slowed down because occupier telling us, I'm very nervous about my margin. The
Hmm.
sales is not grow. Your real estate is so expensive, so my margin become very, very tight. So the trend in that part of the world is all about flight to quality. And now we are seeing that flight to quality also happens here in logistics. And the occupier are telling us they want to have the buildings, which is new buildings and the modern facilities, closer to the market and closer to the consumers. for those facilities which was built before 2020, I think they will have some challenges to fill the facilities.
Interesting. Well, Henry, you are so much fun to talk to. Thank you so much for all this information and for this wonderful report.
Thank you, Kathy, for having me here.
And thank you for joining me here on the Real Wealth Show. As I mentioned, we are launching our multifamily rental fund because we know those opportunities are going to be popping up everywhere and we need to be ready to pounce on it. And you just can't do that if you don't have cash in hand. So we're super excited to get that going. If you would like to find out more about that, you do need to be an accredited investor. We'll have all the details on what that means at realwealthshow.com. Just click on the tab that says syndications. That's group investments, syndications. I'm Kathy Fettke. Thanks for joining me here on the Real Wealth Show. We will see you next time.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.